An ARM, adjustable rate mortgage, is what that stands for. An ARM has some type of adjustment to it. It could be after the first few years. For example, there are many loans today which have a set time frame of maybe 3 years, 5 years, 7 years, or even 10 years, where it's a fixed rate program. And then after that time frame, it can begin to adjust, usually on an annual basis. And that's referred to as a hybrid. They can be either interest-only ARMs, or they can be what's called a fully amortized loan, meaning that you're paying principal and interest during that time frame before it begins to adjust. Oftentimes, the fully amortized types of loans, which are not interest-only, again, the 3 years, 5 years, 7 years per se, someone a bit more conservative who wants to see their principal being paid down no matter what, even if it's just for a few years. They're usually tied to an index, either what's called the Treasury Index or a LIBOR Index, and that represents the cost of money to the bank. On top of it, they have what's called a spread or a margin. And that's basically the bank's profit margin. When you add the two together, that becomes the new rate of borrowing. So if the lender is paying 5% for the cost of borrowing, they're going to charge you, let's say, 7.25% because they're building in that margin if it's a 2.25%.